Find out more about the Canadian dollar and where he thinks it's going as we head into the Canada Day long weekend. We're joined now by Adam Button, Chief Currency Analyst at Forex Live. Adam, thanks a great deal for joining us. We measure the Canadian dollar over and over again, day after day against the greenback. But let's take a step back and look at the loonie versus other major developed market currencies. It's been a strong performer so far this year.
That's right, Paul. It's really an untold story with the Canadian dollar. If you were to measure it against the euro, the pound, the yen, we're looking at gains so far this year around 15%. I mean, it's done enormously well, and Canada, amongst all the major currencies, is second only to the US dollar, and only marginally at that. So Canada's really been able to stick with the US dollar despite, and the Canadian dollar is really a global growth proxy in general, but it's been able to stick with the US dollar despite all these gathering worries about global growth.
How much more is there to the story than high energy prices? When international buyers want to buy our energy, they've got to purchase Canadian dollars to do it, and that is one big factor in pushing the Canadian dollar up.
Absolutely. The Canadian terms of trade are looking very good in the months ahead. You know, manufacturing is running strong in automotive as well. I mean, some of that is slated to slow down later in the year, and that's when the rubber will really hit the road. But in terms of energy as well, it's not just about the prices, it's about the investment climate. And I think we've seen, at least in liquefied natural gas, that there's a renewed emphasis on investing in Canada or opening up, some of the roadblocks that have prevented that for the last 15 years. If that were to go forward, and there seem to be some political tailwinds for that now, you could see some huge investment flows into Canada. And on top of that, it's the Bank of Canada. We have the Bank of Canada still leading the Federal Reserve towards rate hiking in the rate hiking cycle, and that's kept Canadian differentials high in a global standpoint. And finally, the Canadian consumer was sort of last to come out of the pandemic lockdowns, and we're seeing some of that now. Now, as you mentioned, today's May Canadian flash GDP estimate was a little bit on the soft side, so that's worth monitoring, but the last few months have been very strong, and the data in general in Canada has held up very well.
I don't see a huge reaction in the Canadian dollar. I'm looking at an intraday graph right now. Let me see that time. Yeah, it did come down at about 9:15 a.m. Eastern time into negative territory, but not now we're looking at it on our screen. You can't see this, Adam, but our viewers can. The loonie dropping from the green, which represents an advance from yesterday's level, to the red, representing a decline from yesterday's level, but not a huge swing. Is that a surprise, given the flash estimate from StatsCan today about declining economic growth in May?
I mean, I would cautious. It is, you would expect the Canadian dollar to do a little bit worse, especially as we see oil down about $3 here now and near the lows of the session. But I would caution that it's June 30th today, and that means it's the second last day of the quarter. And we're seeing in all markets that the correlations really aren't adding up. We've seen falling bond yields globally, and yet we're seeing falling stocks. This is the time of year when fund flows, investment flows, currency flows, they really dominate the picture. So I think a lot of these moves you're seeing in stocks, bonds, and in the FX market are very challenging to interpret. And you'd be careful to look at the intraday moves and try to draw any conclusions at this moment. We'll see next, starting next week, where we head, and I think we'll get a better, clearer picture then.
Yeah, you in some notes you shared with us, you're cautious, a little skeptical on the Canadian dollar and whether this strength can last in the back half of this year.
That's right. I look at the Canadian, or the Bank of Canada, sort of as the little brother to the Federal Reserve. We're in a race with them to hike right now, and I think the Bank of Canada can probably keep with the Fed close to 3%. But that, I think, is when big brothers can, turn on that extra gear, because Canada has so much to worry about in terms of housing. It's a true bust right now, and I think we'll see prices down in the range of 20-25% when all's said and done. That hasn't really got the attention of international investors right now because there's a lot of angst around housing everywhere, but the Canadian housing bubble is the real deal. And I think also we're seeing this consumer strength that will last through the summer, and then maybe into the autumn that will start to fade. And the market's will start to anticipate that even in the weeks ahead, and I think we'll see the Canadian dollar drift around to that 73-cent level. But beyond that, the commodity picture is good, and I think around the end of the year will be the time to buy the Canadian dollar or buy that dip.
Why don't we finish with the euro? You got some strong views there.
Over and over again, if you were to ask a European politician what their 10 priorities were, none of them would be business competitiveness or economic growth. It's, they're willing to sacrifice so much for whether it's the green agenda, whether it's the war in Ukraine, and we're just seeing over and over again growth disappointing. German employment data was weak today. The data coming out of Europe is just habitually and perpetually weak, and there is no emphasis on fixing that and fixing some of the structural problems. So it's just become an uninvestable spot. And I think we're going to see parity with the euro and the US dollar here. It's at 104 here now, and it just cannot get off the floor. And I wouldn't be surprised if this decade we see parity with the Canadian dollar and the euro, given that there's just no growth there. Interest rates are going to stay rock bottom. And it doesn't seem to be and no one seems to want to change it in Europe. So it's a tough scenario for growth there, and the Canadian dollar will benefit.